Hi, good morning, everyone. Thank you so much for joining our Phillip Security Research 11 o'clock Monday morning call. So today we actually have a couple of macro sector updates, including Mag-7 monthly, Singapore REITs monthly, Singapore Air Transport monthly, Phillip macro update, and also Singapore weekly. In addition, we also have Adobe results, Zixin updates, as well as our technical pause. And for disclaimer, the information that provided in this seminar is solely for educational purposes. It should not be considered as a financial advice. So please seek advice from a financial advisor before making any investment decision. Next, I'll pass the time to Glenn for Mag-7 monthly. Thank you very much.
Hey, thanks, Serena. Yeah. So let's begin with the Mag-7 monthly. Next slide, please. Yeah. So the Mag-7 stocks rose about 4% in August, and it continued to outperform both the S&P 500 as well as the Nasdaq, which rose by 3% and 1% respectively. So we saw four of the Mag-7 companies, Apple, Amazon, Google, and Tesla, have positive returns. And AI has continued to grab the headlines, whether positively or negatively. And each of these counters, most all of them reacted to some form of AI-related news. Meta and Google, they reacted to their AI data center infrastructure collaboration. For Apple, it was mainly the iPhone 17 AI features or the lack of it. And for Tesla, it was their robotaxi and their full self-driving, which is both very reliant on AI. And last but not least, Microsoft's new AI models as well as their open AI integration. So AI is still really the main highlight and the headlines. For Nvidia, it was a relatively flat month. They did have their results released the last, as usual. Investors were mainly really worried that the data center segment revenue missed expectations. So it was about $0.2 billion lower than what was expected. And they were also uncertain about the regulatory headwinds that could impede the progress of their H20 chip sales to China. But nonetheless, if you do exclude this H20 chip sales, they are still guiding for revenue to increase by around 54% year on year in the next quarter. As for the gainers, Apple was the biggest gainer, mainly from the third quarter earnings that beat expectations from stronger than expected iPhone sales. So it continued on to August, as well as the anticipation surrounding the new iPhone 17 launch, which happened about a week ago. I think Serena will go into more details on the launch. And for Google, it was up mainly from the positive legal developments, which prohibited this forced sale of Google Search, and also the potential deal for Apple to utilize their Gemini AI for its Siri assistant. As for the last big improvement came from Tesla, which was, despite their disappointing vehicle sales numbers globally, the investors did remain quite optimistic about Elon Musk's return to the company and the robotaxi as well as their full self-driving promises. As for laggards, it was a bit of from Microsoft and Meta only. So the biggest laggards, Microsoft was really weighed down by the weak third quarter revenue guidance and their supply chain issues, despite having strong cloud and AI growth, while Meta was weighed down by the potential tariff impact. And they also had the smallest Q-on-Q, quarter-on-quarter cloud revenue growth as compared to Microsoft and Google. Yeah. So, but then again, overall, if you look at year to date, Mag-7 was actually up 11% around for the year, and the revenue has continued on from the second quarter, and it has also continued to outperform, if you look at year to date, both the S&P 500 and the Nasdaq. Now, moving on to the next slide, we'll be looking at Nvidia. Yeah, so Ben, sorry, is on leave today, so I'll be covering his portion on Nvidia. I'll be trying my best. So for Nvidia, they had strong earnings, but then again, their data center revenue growth has decelerated, but it's still growing quite well. So the second quarter 2026 revenue and PATMI were within our expectations, around 44 and 45% of our forecast. The data center segment revenue grew 56% year on year, and this was driven by the major cloud service providers' transition to the Blackwell Ultra GB300 rack on top of the existing GB200 RAM. And the second quarter data center revenue has decelerated, as I mentioned earlier, and is the lowest year-on-year increase since first quarter 2025. This is mainly due to an exceptional 154% year-on-year increase that we saw a year prior from the Hopper GPU demand, and also the absence of the H20 chip sales to China, which we estimate around a 10% impact on data center revenue. China still represents uncertainty for NVIDIA. The China percentage of their revenue is at a record low of around 6%. So this is mainly due to the US government's ban on the H20 chip sales. But then again, NVIDIA has stated that the US government has granted some of licenses since August, so since last month, but they have excluded the H20 sales from its guidance for the third quarter 26. So they are still, even excluding this H20 sales, they are still expecting a 54% year-on-year increase. But they mentioned that there's a potential $2 to $5 billion of H20 chip sales in the next quarter. So assuming we are taking the midpoint of 3.5 billion, NVIDIA's third quarter 26 revenue could increase by 64%. So there's a 10% percentage points improvement. So we do think that there will be delays in the H20 sales to China because of not just they must satisfy US but also China's regulatory stance on NVIDIA's AI chips. So but nonetheless, if you look at NVIDIA overall, they have really reduced their reliance. So I think they have sort of expected this on the Chinese market, and it's been down from 26% almost 3 years ago to now 6%. But they have also managed to grow their revenue by 64% CAGR in the same period. So we believe that they are still confident in striking a deal with China since they have made this order of 300,000 H20 chips with TSMC. But then again, even without this H20 chip sales, we believe that they can still beat their guidance, driven by hyperscalers as well as sovereign countries' demands for AI chips. Now moving on to the next slide, we have Tesla. So for Tesla, it's still a pretty disappointing set of delivery numbers. You look at the US now, the US EV market share for EVs compared to total car sales has actually hit a record high in August. This is really from the removal of the US tax credits by end of this month. More details of that later. So they hit a record high and it reached 9.9% share of total new car sales. In July, it was only 9.1%. And the average transaction price or ATP was actually relatively flat. So it means that more cars are being sold. However, Tesla sales have continued to decline, and their August sales actually fell by 6.7% year-on-year. And their market share, more importantly, has also declined to an 8-year low of 38%. So we believe that competitors like Ford, General Motors, and Hyundai are actually continue taking market share away from Tesla with their EV models. In China and Europe, it's a similar story or even worse, mainly due to the more intense competition that they are facing from the Chinese EV makers, especially BYD. So in China, they had a 10% year-on-year decline, while the overall market actually grew by 27%. And more importantly, the battery EV actually gained by 41% year-on-year. They also continue to lose market share. Now it's down by 0.3 percentage points to 6.5%. And this is the lowest that we have seen in 19 months. Similar story also in Europe, with sales declining in Germany, France, and Sweden. And this is despite Tesla actually trying their best with price cuts and attractive financing packages, and also their new Model Y. So more on the removal of the US tax credit by end September. So the Trump administration will end this $7,500 tax credit for new American-made electric vehicles on 30th September, so in a few days' time or weeks' time. And this has resulted in a rush to buy the new EVs before this incentive ends. That's why we saw this spike in the total EV sales. And we continue that in September this trend will continue. However, Tesla has continued to see sales decline as the competitors have started to gain market share, because their cars are, I guess, newer and has more features as compared to a Tesla. So having said all this, Tesla shares were actually up in August, despite all these bad figures, and really it's due to I think it having Elon Musk being out of the news, right, out of the limelight. They really stayed out of the headlines in August, and this would indicate to investors that it's truly back at the company. However, we believe that headwinds from China's competition as well as the tariffs are still present, and we are continuing to see Tesla lose market share to the Chinese EV makers outside their home country. So that's in Europe. And we remain cautious about Tesla given these multiple headwinds, the loss of the tax credits, which will hurt them in the fourth quarter and onwards, as well as market share decline in both China and US. We maintain our sell recommendation and a target price of $220. So that's all I have for Tesla. I'll now hand it over to Serena. Thanks.
Thank you, Glenn. I'll present Apple and Amazon for Helena because she's on leave today. So I'll start with Apple. So the company actually officially launched the iPhone 17 series, which includes iPhone Air, AirPod Pro 3, and also the new models and Apple Watch. In terms of the features, the company actually announced that there will be some of the photos upgrade in iPhone Pro, and also some new health features for AirPod Pro 3 and also the new Apple Watch series. If you look at the price comparison table at the bottom right, the price setting of the new generation actually remain unchanged compared to the previous launch. But you also can see that 128 gigabyte option actually has been eliminated. So instead, the consumer now actually has an option to have a storage up to 2 terabytes. So through this new launch, we actually do not actually see much of a strong upgrade cycle. And Apple is currently lagging behind of other hyperscaler in this AI race. And they also do say that the Siri overhaul is now postponed to 2026. And we actually think that since the pricing remain unchanged for the new generation, it might implies that Apple is currently absorbing all the tariff-related costs. We think that it will likely to weigh further on the profitability because in the recent earnings that the gross margin is already narrowed by 140 basis points. And so for Apple, we actually have a neutral rating with a target price of $200. And next, for Amazon. The company actually announced that they invested 25 million in Colombian delivery company. It's called Rapid. The special things about this company is that it has a really extensive logistic footprint from Mexico to Chile, and it actually offers a turbo service delivery in under 10 minutes. At the same time, Amazon also launched a 7.5 billion New Zealand dollars AWS Asia Pacific region is to support the cloud growth within the local with local data center powered by the renewable energy. So this actually will allow the local enterprises and also the government agency to host workload and also store data securely within the country. Despite a higher tariff, geopolitics headwinds, and also weaker consumer demand, we actually see Amazon continue to invest in the sizable infrastructure and also logistic investment overseas. So instead of scaling back, the company is actually doubling down on last mile delivery in order to improve efficiency and in order to try to capture a cost-cautious shopper in the underdeveloped market. We also think that the company's ongoing commitment in data center expansion will be beneficial in AWS in terms of growth and also profitability. So overall, we actually see Amazon as well positioned to outperform peers across both e-commerce and also cloud computing. So for Amazon, we actually have a buy recommendation with a target price of $260. And next, for Meta. The company announced that they will actually enter a 6 years agreement worth over $10 billion with Google Cloud in order to expand the AI data center infrastructure. And this is actually intend to accelerate the development of the AI model, which is Llama. We actually think that the deal actually aligns with Meta AI Go because they did mention that they're planning to spend around 66 billion to 72 billion this year in order to boost the AI capacity. Therefore, we actually think the partnership is quite positive because we think so if the Meta solely relies on the in-house built infrastructure, it will be too expensive and so taking too much time. If they can leverage Google Cloud capability, it will actually allows the company to keep up with the AI ambitions in sort of competition. And on the other hand, we also think the deals will benefit Google because the business segment is continuing to show some capability to acquire new clients after the recent deal with OpenAI. So we actually think the growth of the Google Cloud will actually allow Alphabet to diversify their revenue stream instead of relying on the digital ad business segment. So for Meta, we actually have an accumulate rating with a target price of $830. And lastly, for Alphabet, the US judge actually rules that Alphabet does not really have to divest Chrome or Android. And the judge actually did mention that the Gen AI search market competition actually did change the course of the case because of competition like ChatGPT. He didn't really see much of the monopoly per se in this case. So this is why that he rules that the Google doesn't really have to divest Chrome, but instead it puts some remedies to focus on preventing Google's traditional search dominance does not really stretch to the Gen AI space. So in his ruling, the company will actually be banned from entering any exclusive agreement related to distribution of search, Chrome, Google Assistant, and Gemini. So before that, they did have such arrangement with company like Apple to ensure that the Chrome or search will be set as a default option on devices. And because of this ruling, they are banned to do so moving forward. And secondly, Google is actually restricted from using a licensing or revenue sharing agreement for the preload and the placement of Google application with partner in exchange for the Play Store access. And lastly, the judge also require a one-time data sharing of search index and user interaction data with the qualified competitors. But overall, we actually think that no divestment ruling is actually considered as a big win for Google because Chrome browser actually is quite a significant role in supporting Google's search business. The Chrome itself does not really generate any revenue, but because it pairs with this browser and the search engine, it actually accounted for around 20% of Google search queries. And then for the remedy specifically, we actually do not think the ban of the exclusive agreement as a major threat for Google at the moment because even though they cannot really enter exclusive agreement, but it does not really stop the company to make any payment to distribution partner to preload or placement of search and all the products. And we actually think that because Alphabet still have a dominance and also has a product quality, the device maker are still willing to continue the partnership, and they do not really they are unlikely to make a sudden shift to adopt other search engine in order to maintain the user experience as well. As for the data sharing requirement, we actually think it poses a limited risk in allowing other emerging Gen AI player to access to Google data and in order to accelerate the training of their LLM. But that one is only on a short-term basis because the sharing, like I said, it will be a one-time basis and it will also exclude Google Ads data. So for Alphabet, we actually have accumulate rating with the target price of $265. And that's all from me. I will pass the time to Fahmi for Microsoft. Thanks very much.
Great. Thank you, Serena. Okay, hi everyone. The following are the updates for the Microsoft in August. For the first update, there were 3 updates that I think that we do find material. So the first update is Microsoft is currently in the advanced talk with the OpenAI. So Microsoft is the OpenAI's largest investors with $13.7 billion US stake and is currently seeking to protect its long-term access to the technology beyond the current agreement, which is expiring in 2030. So Microsoft is trying to secure its continued access to its OpenAI AI technology, even if OpenAI reach artificial general intelligence, because reaching the artificial general intelligence means that in their current partnership agreements, means it would limit the Microsoft right to OpenAI technology. So both parties have been negotiating for this for ongoing months as OpenAI is moving toward becoming for a profit company. So negotiators have met regularly and talks are progressing positively, and we think an agreement could be reached within weeks, right? So that's for the first update. Second update is that Microsoft integrated OpenAI GPT-5 into its product ecosystem as of 7 August of 2025. So OpenAI GPT-5, they already been integrated, and it is actually one of the most advanced AI model that we have currently from OpenAI, and it was already integrated across Copilot, GitHub, and Azure AI Foundry. The model was trained on Azure, the Microsoft Infrastructure Service Business, and it provides the latest reasoning models to deliver the right tool for consumer, enterprise, and developer needs. The GPT-5 is free in Microsoft Copilot, and it is only available to paid subscriber of GitHub Copilot. Last update is that Microsoft launched its first in-house AI models. So where they previously, for the last few years, they used to already relies on OpenAI for their AI technology. On August 28th, Microsoft AI division announced its first internally developed models, which are MAI Voice 1 and MAI Preview. MAI Voice 1 can generate a minute of audio in under a second and already powered tools like Copilot Daily and AI podcast discussion with customizable text, voice, and style. On the other hand, the other AI model, which is MAI 1 Preview, is the Microsoft first end-to-end language model built entirely in-house and is capable of following the instruction and providing helpful response to everyday queries. So our view for this news, we think this recently AI move by Microsoft is strategized to secure long-term leadership in the field. First, you look at it, the company is mitigating risk by ensuring continued access to cutting-edge AI technology from OpenAI. That is, even if OpenAI pivots or change its business model, separate from the current partnership agreement. Second, Microsoft is strengthening its competitive position by integrating GPT-5, which is more powerful AI, into its core products and service ecosystem. Finally, Microsoft is reducing dependency on OpenAI, especially amid the tension between the two parties by developing its own models. But although it is still early, we do see that this is a step toward its own proprietary language capabilities. For Microsoft, we maintain accumulated recommendation with an unchanged target price of $550. Next slide, please. The summary, to conclude, we remain overweight on Magnificent 7. We see the digital advertising remains strong, pricing continue to improve, and the highlight, which is the $10 billion 6-year AI cloud deal between the Google and Meta, will further increase their dominance. For Apple, the new release iPhone 17, in our view, still lack any significant AI enhancements. So except for Tesla, we believe the Magnificent 7's earnings growth will continue to outperform both the S&P 500 and the Nasdaq 100. The tailwinds includes greater adoption and demand of AI with the US government's AI action plan unveiled in July 2025 and renewed interest in AI following strong second quarter 25 earnings. That is all for Magnificent 7. Next slide, please. Next slide, please. So Adobe recently released their third quarter 25 results, and they deliver another top-end guidance beat. For the year-to-date revenue and adjusted PATMI, they made our expectation at 74% and 71% of our FY25 forecast. Looking at the positive, the digital media strength drive revenue above guidance again. So in the third quarter, Adobe's total revenue rose about 11% year over year to $5.99 billion, exceeding the top end of the guidance at $5.93 billion. The digital media revenue grew about 12% year over year to $4.46 billion, led by creative and marketing professional group. Demand AI-powered tools such as Firefly and Gen Studio remains strong. We see increasing adoption for these services. For example, Firefly monthly active users rose about 30% on quarterly basis, with 29 billion AI generations up to date. So the business professional and consumer group gained about 15% year over year, driven by Acrobat Studio, AI Assistant, and cross-platform use. The usage for product for this service is also increasing. Acrobat and Express monthly active users was 25% year over year growth. For the second positive point, full year guidance was raised for the second time this year. The company now expects revenue of $23.65 billion, which was up from $23.50 billion. The earning per share was also raised to $16.53. The revision was driven by robust subscription growth, operational efficiency, and the accelerating adoption of AI. On the AI integrations, Adobe's AI influenced annual recurring revenue surpassed $5 billion, while the AI first annual recurring revenue exceeded the $250 million that the year-end target that was set at the beginning of the year earlier. The users find the AI features in their subscription was very helpful. It helps them to cut costs and speed up their workflows by using AI instead of doing it manually as usual. For their outlook for the fourth quarter of 2025, Adobe is guiding for total revenue of $6.10 billion and adjusted earnings per share of $5.38, both reflecting 11% year-over-year growth. We believe this outlook suggests continued momentum in Adobe's core business, particularly its AI-enhanced offerings. The digital media segment, which is their largest business segment, is expected to grow by 11% year-over-year and to be supported by strong uptake of Creative Cloud Pro and Acrobat Studio package. Our recommendation, we maintain a buy recommendation with an unchanged target price of $560. We raised our FY25 revenue estimate by 0.3% following Adobe's strong third quarter results, but it was offset by a higher expense estimate due to the increased investment in AI and product development. Our view is that we see that AI adoption at Adobe is accelerating rapidly. Adobe's AI direct annual recurring revenue, which is the revenue that comes directly from their AI product subscription, already surpassed the $250 million year-end target that they set at the beginning of the year. While the AI influence revenue, which is an indicator for total products revenue with AI features integrated into them, surpassed the $5 billion year-end target. We believe this demonstrates quick uptake since they begin monetize of their AI product at the beginning of the year, with their revenue from AI growing double since the beginning of the year. However, while revenue from direct AI products has started to come in, it's unfortunately still small. It's only represent a small portion of the overall revenue. The $250 million that mentioned by Adobe for their AI direct revenue is only making up only 1% of the total yearly revenue last year. But then again, we still see upside potential. Adobe has a vast customer base across its Creative Cloud ecosystem, including millions of users for its creative products such as Photoshop, Illustrator, and not to mention they also have millions of users in the Acrobat PDF users, which they can effectively integrate AI into these existing products further, and hence significant room for growth for further monetization. Beyond AI, we remain confident in Adobe long-term prospect due to its leadership in the creative industry, not only on their AI. The company continues to offer a diverse portfolio of products, generate recurring revenue, and show steady growth. That is all for me. I will pass over to Darren for his Singapore REITs monthly. Thank you.
Yeah, welcome to Singapore REITs monthly. So, title, we're expecting 2 more rate cuts in 2025 after the cut last week. Hopefully, 5 basis point cut next week. Last week. Yeah, so this is the share price performance of the REITs in August. So you see more subsectors were up, and notably the diversified sector in Singapore, mainly those with Singapore assets like CSCP, OEP, all performed very well. Year to date, last month as well. So you see the overall REIT index is up 7.3% year to date. And that is after the very weak first quarter, the REITs really rebounded like almost 10% over the past 3 months. Prospects of rate cuts. Yeah, so please. Yeah, so next we move on to our monthly indicators that we monitor very closely. So this is a 10-year dividend yield spread. So what this means is how much investors are being compensated when they invest in so-called the risky asset REITs as compared to the risk-free rate or 10-year Singapore 10-year SGS bond or 10-year government MAS government bond yield. So that is a risk-free rate. So right now we see that investors are being compensated near the 10-year historical average, which is around 3.8%. So we think this is attractive as going forward. The absolute number of people is expected to increase from finance cost savings from lower interest expense, as well as the fact that with low interest rates, the 10-year yield, the bond yield will continue to decline. As you've seen in the table on the right, the 10-year yield is already falling quite significantly, and now it's at 1.2% as of the end August was 1.83. It's fallen more since then. Yeah, and another thing to note is also the 3-month SORA has really fallen, or rather more than half. So now it's at 1.6. Yeah, the 3-month SORA it fell like almost 200 basis points year on year. So that is really another tailwind for the REITs as well, especially with those with Singapore dollar limits. Singapore dollar, Sing dollar asset in Singapore. Yeah, sorry, excuse me, next slide, please. Yeah, so this next slide is a forward dividend yield. It has fallen, but that's mainly because of the fact that the recent share price performance was very strong. This past 3 months was up almost 10%. So that was why the forward dividend yield has fallen. But going forward, like I mentioned, we do expect this yield to increase from the increase in the absolute number of DPU or payout, or rather from DPU growth year on year. And price to NAV is still trading below historical averages, despite the rally, and now it's about 0.97 times. At these levels, we still think it's attractive as a prospect of more rate cuts will continue to benefit the REITs, and they'll continue to benefit from lower finance costs, as well as the fact that if lower rates, cap rates will likely to compress over time or gradually, and that will result in higher property valuations as well. Yeah, so those are tailwinds for REIT. Next slide, please. Yeah, so moving on, I'll talk a bit about Centurion Accommodation REIT, the upcoming IPO that is expected to start listing later this week. So Centurion Accommodation REIT is a pure play purpose-built living portfolio. So this is the first of its kind. So usually we notice that, or rather previously the other REITs that have PBSA assets, they are more hospitality. So they do have some hotel exposure or some other service residence exposure as such. But this one is a pure purpose-built living portfolio, meaning it's just PBSA and PBWA. Which is purpose-built student accommodation, purpose-built workers accommodation. Yeah, so the initial portfolio for this Centurion Accommodation REIT will consist of 14 properties. So it's valued at 1.9 billion, or 1.84 billion. So 8 PBSAs in UK, 1 in Australia, and 5 PBWAs in Singapore. So Singapore will contribute about 73% of AUM. And the enlarged portfolio that you see on the top right, so that includes the acquisition of Episode Macquarie Park, so that they've entered into a forward purchase agreement. So that will complete when the Episode Macquarie Park is completed. So that's expected in February next year. So after the acquisition of that, the enlarged portfolio will consist of 15 properties, and the valuation will be 2.1 billion. Yeah, another thing to note is that for the retail tranche this time around is just 13 million units. So at 88 cents, that will be a value of about 11 million, slightly over 11 million only. So the retail public offer tranche is relatively low this time around for Centurion Accommodation REIT. So the sponsor, Centurion, which my colleague Iqbal covers, we will continue. You will hold 45.8% upon the IPO, and they've indicated that they will distribute a dividend or distribution in specie in 2026. So that will reduce their effective stake to around 35 to 40%. But this 35 to 40% is still a very large stake. So basically alignment of interest with the sponsor for the REIT. Sorry. Isn't there a voice breaking? I was so sure. So hopefully it's still audible. The initial gearing of 20.9%, so that's very low gearing. It's expected to increase to 31% post a fully debt-funded acquisition of Episode, like I mentioned earlier. So after the acquisition of Episode, that will bring the gearing to 31%. And the debt headroom is still based on 45% gearing after the acquisition of Episode will be 559 million. So that is ample debt headroom for them to further grow their portfolio through inorganic means, either through their sponsors' pipeline of first user assets or through external acquisitions in the PBSA sector. Yeah, so for them, their projected yield is 7.47%. So that's FY26 dividend yield. Expected to rise to FY to 8.11% in FY27. And right now they are paying 100% payout ratio. That's in the forecast. And they did mention that after the first 2 years, they might lower their payout ratio to retain some for capex and some green purposes. But yeah, generally definitely the distributable, or rather the payout ratio, will remain above 90% for them. Yeah, and also another thing note is that for this dividend yield, their projections of this 7.5% dividend yield is that the management fee is 100% paid in units. Yeah. Next slide, please. Yeah, so just our quick take on our quick view on this IPO. So although the dividend yield like 7.5% in the first year is definitely higher than like the sector average. Like we saw the star was 5.6% in my earlier slide. So we are getting a score of premium based on the dividend yield, but there are some rather things that we are wary about. So one of it is that for their whole portfolio, the leases are all generally less than 1 year. Like as for the PBWA, the leases are on a yearly renewal, and for PBSA is based on every academic year. So all these so-called heightens or increases the income visibility risk in the longer term, as the income is only visible for the year, for 1 year out when they sign the lease. But the silver lining for that is that the retention excuse me. The silver lining for that is that the retention rate for the PBWA assets over the past 3 years was very high at 85.2%. And going forward, we are also expecting about a 3% rental reversion growth. Every time they renew their lease for PBWA, and when they sign PBSA leases, we expect like a 3% rental reversion growth. So that is quite modest growth. But I guess the good thing for them is that for right now in the current market environment, the PBSAs and PBWAs, there are still some very strong demand supply dynamics that are in their favor. There is very strong demand. Supply, is a little bit constrained for now for PBWA. Yes, and we see the demand for PBWA, like based on the workers' needs, like from construction, marine and such, is still very strong. Yeah, so in the near term, we don't foresee any risk, but who knows, 10 years or 20 years down the road, if any government regulatory changes or demographic shifts or foreign labor policies, all these could affect demand. So those are the biggest risks that we see for this REIT. Yeah, and like I mentioned also that earlier, ample debt headroom, they have ample debt headroom for further inorganic growth, so that is also a positive for them. So for overall, our stance is just slightly positive for this REIT. Yeah, and on the right side of the table, there's a few charts over there. So based on the agreed property value, most of their assets are either on freehold or more than 30 years leasehold, like 86% of it is freehold or more than 30 years. Yeah, and it's noted that assets, the lease decay in Singapore only happens usually when assets have less than 20 years lease remaining. Yeah, so for them, they are still in a fairly good position. Yeah, next slide, please. Yeah, so this is just the important dates and times if you would like to subscribe to the IPO, which is not a very big portion, just 11 million, like I mentioned. So you have until tomorrow 12 p.m. to subscribe, and the REIT will commence trading on Thursday. Yeah, so if you want to subscribe, it's really soon. You have to start applying, or if you've not already done so. Yeah, next slide, please. Yeah, so moving on to our other subsector indicators in our REIT monthly. So first of all is the retail sales. So July numbers were up 4.1%. It's still strong. We still favor the retail subsector the best, as we believe positive rental reversions will continue in the high single digits for both downtown and suburban malls. So that is very resilient, and it's supported by occupancy costs that are still low, below historical averages, and constrained supply. So we favor the retail subsector, and especially suburban retail, like for FCT. Yeah, next slide, please. Yeah, so for visitor arrivals and hospitality in Singapore, we noticed that visitor arrivals is up 4.5%. So that's good sign. And hotel RevPAR is also up 3.8% in July. So visitor arrivals are now just 7% below pre-COVID level. So that is also a good sign for recovery. And RevPAR is already 22% above pre-COVID levels. Yeah, so going forward, we still believe, we still stick to our forecast that RevPAR will be a low single-digit growth for the full year 2025, and that visitor arrivals will pick up to around 95% to 100% of pre-COVID levels for Singapore. The next slide, please. Yeah, so this is a table and just around all the stocks cover and the target price and TPU and such. Yeah, so that's all I can on the same. Thanks.
Thanks, Darren. I'll move on to the technicals. Next slide, please. Yeah, so first up for S&P 500, last week it was up 1.2%. It continued to form new highs on the chart. However, I think this week wise, we're likely to see some sort of a sideways consolidation or possibly a slight pullback as the price is actually quite near the short-term trendline resistance as shown in the chart. And yeah, currently it's holding around the 5 and 10-day moving averages, the blue line as well as the red line as support. So currently for resistance could be at 6,695 to 6,760 area, while support could be at 6,550 to 6,625 area, which is the swing low last week as well to the area where price actually broke out of the horizontal resistance on Thursday. Next slide, please. Yeah, so next one, I'll move on to the Phillip macro update for September. So we titled it 2 more cuts projected this year. Next slide. Yeah, so for the FOMC meeting last week, they cut 25 basis points to 4 to 4.25% in line with market expectations. So looking at the dot plot wise, it was they expect 2 additional quarter point cuts this year, 1 more than projected in June. And the only sole dissenting vote was by Governor Miran, who wanted to lower rates by 50 basis points. The dot plot continued to show a wide disparity of views among officials, continuing on from the one we saw in June, where the median was only held at 2 more cuts by a narrow 10-9 split. Second point is that as compared to the June projection, now the participants expect a slightly lower path of rates for both next year as well as 2027, with an additional quarter point cut projected. So for 2026, the median projection decreased to 3.4% from 3.6%. And for 2027, the median projection was down to 3.1% from 3.4% in June. So all in all, they foresee 1 more cut in next year, as well as 1 more cut in 2027, and towards the long-term neutral rate at 3%. Yeah, even though this is 1 additional quarter point from June, it was still slightly below the current market pricing of 2 rate cuts next year. And then the third point is that they see stagflation risk currently easing from the updated economic projections. So they upgraded the outlook for growth by 0.2% from the June projection, while the outlook for unemployment and inflation were unchanged at 3% and 4.5% respectively. Yeah, and for 2026, they revised higher the forecast for real GDP and PC inflation, while revising lower for unemployment rate. Next slide. Yeah, so in terms of the changes in the FOMC statement this time, much of the wording was focused on the labor market. So we see that some of the notable changes include, which Powell kept repeating, was downside risk to employment have risen, and also the shift in balance of risk, which was also said during the Zixin Group conference. And also a sentence that mentioned labor market conditions remain solid was actually removed this time. And the fifth and last point was that during the press conference, we can see that Powell actually has moved from the wait and see approach, which he typically took in previous meetings. And he also remarked that he can no longer say that the labor market is solid, and recent pace of job creation is running below the break-even rate. However, he also stopped short of signaling this as a start of an aggressive series of rate cuts, and he just continued to state that the Fed was still in a meeting by meeting situation, and this was more like a risk management cut. Next slide. Yeah, so in terms of our outlook, we think that the meeting reflected a cautious, however, it was a mildly dovish stance from Powell, as he emphasized multiple times the growing downside risk to the labor market. However, he still maintained confidence in the overall economy, and he signaled that the current risk from the labor market was outweighing the concerns from tariff-led inflation, where he feels that the base case remains a short-lived impact. Yeah, and so overall, we see the meeting as sustaining the Goldilocks move for the markets, with the median to upward projections in line with market expectations for 2 further cuts this year, on the backdrop of higher growth expectations in the dot plot, and Fed shifting the balance of risk towards the labor market. Yeah, so that's all from me. I'll hand over time to Paul for an update on Zixin. Thanks.
Thanks, Dean. Just to give you an update on Zixin, I'm not Meow Meow, so I didn't read the report, but let me just give you an update. So in next slide. So the main event that happened was that the Zixin they issued 889 million share options at 3 cents. I think at the time the share price was trading at 3.2 cents. This is about 34% of the fully paid up capital, all the number of outstanding shares over 5 years. So the key thing is, of course, investors will be worried that this will be dilutive and will be a bit of old shareholder hang. But the positive for us is that the shares will be allocated largely to the CEO and also to a financial controller and some other investors. To us, this is positive, mainly because I think because if it's a Chinese company, and then it's always positive to see that the management is willing to is looking to double his or her stake in the company, which is currently around almost 16%. So this will push it to almost close to 30%. Yeah, not to cross the 30. So just to recap, the usage of the money will be for Hainan and also for working capital purpose. So just to recap, the 3 main drivers for this stock is number 1, if you look on the right, is fresh sweet potato. So for those who just to dial back, so they are based in Liangcheng. I'm not sure where that is now, but they are specializing. What they do is they actually grow the seedlings, and then they give to the farmers to grow the sweet potato, and then they will buy it back. What we've seen is, back to the first point, is that the sweet potato growth has surged, mainly with the support of the government. So the government has given them a lot of coal infrastructure for food security purpose, and because of that, they managed to expand the capacity so they can store longer, and then they can and also manage the longevity of the sweet potatoes. So that's why the production of fresh will rise. The second thing is that apart from just selling the fresh, they are also selling processed. So they will take it and make it into snacks largely, and they've extended it into more street variety and continue to improve it and brand it better. And also they're also moving it into functional food. That means sweet potato powder, which we'll use as an additive. So for that, we are looking at sales of 28%. The third growth driver, which is a bit more medium term, if you look at on the left-hand side, the 4th bullet point. So what has happened is that together with CITIC, which is of course the huge investment arm of China in China, so they're actually going to government's going to give them land, which is 500 acres. So this is 5 times larger than what they're doing in Liangcheng. So they're going to do the same thing. So basically, the government's going to support them with land. They're going to grow the seedlings, then use the seedlings, supply it to the sweet potato the farmers, and then buy back those sweet potatoes from the farmers, and they will handle the rest. Yeah. So, but that will only start to happen in 2027. But again, all this is because in the background, the government wants to raise the use of sweet potato, of course, for consumption and also eventually for feed meal, for poultry and so forth. And of course, they're using Zixin because they are the experts in this whole sweet potato supply chain and looking to industrialize the whole sweet potato supply chain. So we still maintain a buy 6 cents. The stock is trading about 5 times PE, but half the market cap is in cash. Or I mean, 60% is in cash. Next slide. So I'll move on to her again. I'm not Meow Meow. So let me just move on to her air transport monthly. Next slide. So in terms of the performance of the air transport related stocks, the big gainer was China Aviation, up 17%. The rest, I think we can see, the rest are basically flat. Next slide. So if we move on to some of the data points that came out. So SIA, the numbers was actually quite positive because the passenger traffic was 5 and it is faster than their growth in capacity. So this should mean that they should have some better yield. And that was the big worry that I think investors have because of the yield, which is the pricing of SIA. Next slide. So I won't go through this. I don't think that's really. It's a bit more factual here rather than giving an outlook. I mean, next slide. In terms of our view, I think we still have a reduce on SIA, but there will be some positives because of the lower fuel price together with the lower US dollar. So that should help the margins. Sets, we still have an accumulate, but of course the whole issue with e-commerce and with the de minimis rule, then I think that's our concern. We still have a buy on China Aviation, although the share price, at 150. Mainly because they are moving into SAF and that should give them better margins. And essentially, China Aviation Oil is essentially a monopoly because they have you can think of it like a petrol pump in the Shanghai airport, and there's only one petrol pump. SIA Engineering, we just initiated. We still have a buy. The valuation based on 25 times PE, whereas the industry trading about 36, and they have a net cash of 580 million. The thematic around SIA Engineering is because of the delays in aircraft. So aircraft is actually lower. Deliveries are actually lower than pre-pandemic, and as a result, the older aircraft are being used more, and that's why they need higher and higher maintenance. Yeah, so that benefiting SIA Engineering. Next slide. I'll move on to our usual Singapore weekly. Next slide. So in terms of some of the key macro data highlights, we had the new launch, residential launch in Singapore, 2,142 units. So this is almost like 9 times higher than last year. And of course, this July was also strong at 633. So I mean, this sharp pickup, if it continues the next 1 or 2 months, then I think it does concern us. I mean, it does worry that there could be cooling measures, especially on the leverage part. The other thing is the construction activity is picking up. So although we always say that construction awards is rising with 40-50%, but the activity hasn't picked up until recently. If you look at this ready-mix concrete data, so June, July, it was basically flat in the first half, but June, July, we're starting to see a 10% jump or low teen start of growth coming up. So this should mean stronger results in the second half for our RMC, which is largely Pan United and also Hong Leong Asia. Visitor arrivals in Singapore is actually also growing. This is the second month of growth after first half also was pretty soft. And curiously, the one that's spotting the arrivals is not Asia, actually European arrivals because of summer actually jumped almost 15-16%. In China, the data that we got was still pretty weak. Retail sales is still soft. I mean, in their context, I mean, it's softening to 3.7%. Property starting to decline back again. I think in the second quarter, it started to stabilize and grow a bit, but then in the recent quarter, it's starting to drop down again. So in terms of the US, the big data point was retail sales. Because retail sales actually spiked up, but again, it's the fastest growth in 30 months. But we're just not sure because how much of it is actually front loading buying ahead of the tariff. So we're still not clear. Is this the underlying trend of the consumer in the US? Next slide. Okay, in terms of our tactical views at what Zane mentioned, so for us, we are still expecting 2 rate cuts this year, which is the October and December meeting. Why we still have the expectation is because even in the Fed statement, their base case is that the tariff impact, which we all know will raise prices, at least their base case or their base assumption is that it's going to be short-lived. And they are more worried about the downside risk to employment. So long as they believe that, whether it's really reality and whether you agree or don't agree, we think there's probably room for 2 more cuts. Last week, there's a lot of central banks announcement, UK, and so most of them kept rates flat, except if there are most central banks either keeping interest rates flat or they're cutting. So Norway, Canada, Indonesia have all cut. Of course, the one that is doing the opposite is Bank of Japan. They didn't raise interest rates, but they are tightening monetary policy by selling their, I think, 200 billion of ETFs that they hold. They are going to sell 2 billion, so if you do the maths, like 100 years to clear, but it is a sign of Bank of Japan tightening. So for us, we still think interest rates are coming down. Of course, you may or may not get the exact number right, 2 or 3 or 4, but for us, our general view is that as the Trump administration takes more control of the Federal Reserve, monetary policy becomes a fiscal tool. What that means is that it becomes a stimulus. You have a fiscal tool means you just use it to stimulate when the economy is big, regardless of inflation. So one area that we think will benefit will be the US office, because we think the US office fundamentals have turning more positive. So what we see is on the demand side, demand is increasing because there's a 10 times jump in the return to office. It used to be 5%, now it's 50% of workers are now full-time, and we should expect it to continue to rise. The other driver is that there's more capital and refinancing. There's no hard data on this, but I think anecdotally we do see in the US news that more funds are coming into the office, and also banks also doing more refinancing. And this should accelerate, with interest rate cuts. Then on the flip side, for US office, supply is muted. So under construction, the next 2 years is about 3 million on average, versus I think 2018 to 2024, the average per year was 18 million. So this is like 85% decline. So with and not only that, construction costs since the pandemic is up 45%. So for us, we like the sector because directionally it's positive, because supply is really constrained, and and demand is starting to creep up and more capital is coming in. We can't be exact on the trajectory. Will it be sharp? Will it be slow? But I think we think that directionally it's still going to be positive. So one US REIT that we like, which of course Darren covers, is a prime US REIT. So the occupancy rate for prime has ticked up after 7 years of decline. We'll show you a chart later. So after 7 years, it's starting to recover and bounce back. And for us, occupancy rate is a lead indicator, because if occupancy starts to climb, then rents will follow through. And of course, the big problem for office REITs now is they call it tenant improvement. Because to attract tenants, you need to come up with money, capex. So we think occupancy is the lead indicator, and that's turning positive. The other 3 points for that is that we think the debt has de-risked, because the next refinancing is only coming in 2027. So this year and next year would still be fine. And also, the major lease expiries will only happen 2027. So at least we still have a positive runway the next 12-18 months. And the stock is trading at 70% discount to book. In terms of some of the key events to watch will be the US core inflation. Sorry, this is an error here. 17 is already over. Yeah. Next slide. Okay, the one on the left, just ignore all those red lines. I mean, those are the cooling measures. But just slightly a bit worried because the sharp bounce in transactions. Of course, it came down a lot, but I think the just extremely sharp, so it's a bit worrying. Construction activity is starting to pick up. If you look at the chart on the right, this is a ready mixed concrete demand. So those just in case, ready-mix concrete demand is basically wet cement. So you can't, when you have a new building, you have to pour all the concrete or wet concrete. Basically wet cement. Then that's what they do. So that is starting to climb after declining. I think the last few months, maybe the last 1 year, you can see the growth rate has been slowing down, but it's starting to perk up. So this should be positive for construction company earnings. Next slide. This is China. So most of the data we see from China is still weak. If you look at this is consumer spending. The one on the right is basically residential activity. So the blue line is residential slow. It started to flatten out a bit, but then again you can notice the blue line is starting to come down. But activity of space completed, that means this is actual construction activity, which is like real GDP, I guess, or yeah. So that is actually sliding down quite sharp. Because without any property sold, of course, activity will just slow down and that is sharpening, and this will impact the economy in China. Next slide. The only one, the other thing is deleveraging is still happening, because if you look at the red line, so this is loans growth. Sorry, not growth percentage, but the amount of loans that is being dispersed the last 12 months compared to the savings. So you can notice that the Chinese are saving a lot. I think this is 200 trillion, if I'm not mistaken, 20 trillion. So I need to double check the number. But this is, I think, 20 trillion of 20 trillion of savings that the Chinese have. And of course, the amount that they are saving is it used to be they were leveraging more, but then now they seem to be saving more. Obviously, confidence is low. The one on the right is just to show exports is the one that's supporting the economy in China. Next slide. Yeah, okay. This is my last slide. So this is the occupancy rate of prime. I think it's basically one way down. I mean, this occupancy continue to drop. Only the last quarter is starting to pick up. Keppel Pacific is a bit more stable. The data on the right here is just the office attendance policy from GLL. So this actually is widely used. I think almost every office presentation these days will have this chart. But this basically shows that 2 years ago, 5% was in office full time, and then now it's 50. So what this means is when it jumps so much, means there'll be more demand for office space, because maybe they were planning for less people to come in, but now everybody start to go back in, then it will drive the demand. Okay, thanks. I think that should be my last slide. Thank you, everyone.
Yeah, let me take some of the questions first. I'll try to do the one on because Helena's not here, so let me just do the one on Apple. Apple recent launch of iPhone 17 is well received and share price went up. Still good to sell some. Yeah. So the launch of the iPhone 17, we did see some strong demand. I think because you're coming from the 16 to the 17, there isn't really much difference with the phones. I think the main difference would be the release of the Air model. So that's the only really big difference. I think what's lacking for Apple, I mean the differences is battery improved, they changed a new chip. Yeah, that's pretty expected already for a new phone to release. And I think more importantly, the price is also similar, right? So that might be one of the reasons why we are seeing this strong demand, because they didn't put in the tariff impact into the phones. Maybe it's what Tim Cook discussed with Trump behind closed doors. Nobody knows, right? But that might be one of the reasons why we are seeing strong demand. Because apart from that, there really is quite little changes from the iPhone 16. I think the most important thing is that they are really quite behind in the AI department, right? They are, they don't have their own, I would say, like Google or even the Microsoft, right, where they have their own AI built into a lot of their products, or even Adobe has their own AI built into their products, right? They are depending on other companies' AI, so their own AI is not up to the mark yet. So it's still a bit risky looking in the long run whether or not this demand for the phone sales can actually maintain. Yeah, I think it got pushed back again the Apple intelligence got pushed back again till I think the next year. So maybe the users as well as the investors are quite already accustomed to this, continuous delay in the Apple intelligence. And maybe if they don't have it, then they won't know what they're missing out. Because most Apple users don't use Android phones. Yeah. Yeah, so we do have I think a reduced call on Apple now. Yeah, there's one on the banks. Let me try to find a question. Yeah, what's the outlook on the Singapore banks after the recent sell down? Yeah, good question. The recent sell down really quite related to the Fed rate cut. So I think I've said this multiple times. It's that the Singapore interest rates have diverged quite a bit from the how it was, for quite a few years, where it will follow the Fed rates, right? Where if there's a hike, you go up, and then if there is a cut, it will go down, right? So it's quite related. But recently, what we are seeing is because of this influx of funds into the Singapore market and also the Hong Kong market, we are seeing a lot of the rates actually decline, even though the Fed rate cuts are like minimal, or they haven't been cut, at least, for quite a while, right? But we see Singapore interest rates decline, and similarly for the Hong Kong rates as well. Yeah, so that's for the banks. And what does this mean? Basically, it means that I believe that the flow through from this rate cut that they did, will not be as impactful. There will be some impact, there will be some flow through into the Singapore rates, but it will be a lot lesser than it was maybe if you're talking about 1 or 2 years ago. And so this is a bit more positive for the Singapore banks, because in the sense that their loan yields will not be as badly impacted, and also they will be able to manage their NIMs a bit more and maybe control some of that NIM compression. The story is still the same, right? They will see NIM being compressed from the declining rates, and the only way that they're going to combat this is by improving funding costs, which means cutting your fixed deposit rates, your current account rates. So we have seen UOB and OCBC do it quite aggressively because they hiked it very high, and then now they are lowering it. Their CASA accounts, so their current accounts, like their one account or the 360 account. Yeah. So that's how they're managing their funding costs. But then again, with lower rates, we expect loans growth to improve. Loans growth has been at a pretty good levels. It's currently around 6+%. So we'll see it, keep going up, which is expected with the lower rates, where the consumers, are more comfortable taking up a loan. And the other segment that will benefit will be the fee income, because now you can't really if you put your money into a fixed deposit, you're earning like 1+%, right? So the banks will be more aggressive in trying to promote their wealth management services, and that's where you will see their fee income growth. So these two, loans growth and fee income growth, will help to offset some of the net interest margins decline. And more importantly, the banks are quite committed to giving their capital returns. I think DBS is the most committed in increasing dividends, and also the most stable dividends, because they are giving a fixed dividend per share, whereas the other two is floating and semi-floating, so really dependent on their earnings, and which is why we could possibly see the absolute dividend per share actually declining for UOB and OCBC, because earnings decline, and then while they're giving more in terms of percentage wise, but if the earnings decline, you look at the absolute dividends, is actually lower than it was the previous year. For DBS is a different story, because they're giving fixed, so that's why their dividends will increase absolute amount, and also if you look at the dividend payout ratio. Yeah, so that's all for the banks. Overall, yeah, the dividend is for our topic for the bank, sorry, is DBS, because of this dividends, fixed dividends that they have. Yeah. I think that's all I have. I'll hand it over to the rest of my colleagues. Thanks.
Based on Zixin IPO and its projected yield, what is the risk, especially to yield? Yeah, I gave quite a presentation earlier. I'm sure you said, quite who's control the subject? Back to the slides, please. To the Centurion slide. Yeah, I think there is some questions on this. Yeah. 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 So, yeah. So it's 7.5% next year and will rise to 8.1%. So one of the risks is definitely, like I mentioned, the yearly renewal of the whole portfolio. The PWA assets are on a yearly renewal. So every year when the lease expires, like 3 months before the lease expires, they will start to discuss again, like to renew the lease. And for the PBSA is every academic year. So that is slightly less than 1 year. So that is the very short-term leases of the portfolio. So the whole year on the portfolio is less than 1 year. So I think that is the shift out here. Yeah, so first. But do I think whether it's worthwhile for retail investors to subscribe? Yeah, so in my opinion, I think um the offer is not very large. It's just 11 million. So I think if you are just if you want to diversify, you could add a small portion of your portfolio into this Centurion REIT. But if it's just like a pure like because of this asset class, right, it's in PBWA purpose built. It's so you could add it into your portfolio for just a little bit of diversification. But if you just want to go like a large percentage or a huge chunk of your portfolio in this Centurion, yeah, I wouldn't. Coming on bounce and also the proposed REIT listing. Yeah, so it's still in the very early days. There's prospectus not out yet. Not that I know of. And yeah, but from what I know, they'll inject 23 assets into the portfolio. Yeah, so it's still very early days. So yeah, I'll update as I get more info as well. Why Centurion price drop? Is it due to the re-IPO? My colleague Ipan covers Centurion, but from what I see, the share price, Centurion has really risen so much in anticipation of the IPO. But once post the announcement, or rather the re-IPO, the share price kind of corrected a bit. Yeah, in my opinion, I think it's just part and parcel of trading, because basically you can't expect the share price to just keep running, and the share price has really risen so much. Yeah, the share price has risen year to date was really almost 81% in anticipation of the IPO. Since June, it's just risen over 50% or so. So yeah, I just think it's just but some investors just taking profit. Yeah. And sorry, I don't really have a good answer to that.
Yeah, I think for the Centurion IPO, the other thing you have to watch is that Centurion is going to give dividend in specie. So after listing, they did mention, I think from Bun's report, if you recall, that Centurion probably might give up some of the shares that they have in the Centurion REIT to their shareholders. So this could cause some overhang a bit on the Centurion REIT IPO. So that's something to watch. The second thing for us is that if you want to play, if the Centurion IPO really does well, I think one better way to play it would be through WeHer. I think because WeHer has a new 10,000 bed dorm coming up. And our recent conversations with some companies is that the monthly rate for dorms now is hitting $700. It is so high now that they have to go and build their own dorm in their own factory. Which is not so good in the long term, but in the medium term, the dorm rates continue to rise. And of course, WeHer also has construction. So for us, a better way to play this would be through
Yeah. So yeah, like Paul mentioned, post IPO Centurion will own 45.8%, and they indicated they will reduce their stake to about 35 to 40% through the dividend in specie. Yeah, I also went through that during the presentation. Can advise why REITs will be dropping since the Fed announced a rate cut. Yeah, so in the past 3 months, the REITs have really rallied. So I think this is just a little bit of that part and parcel of trading as REITs over the past 3 months have rallied over 10% in anticipation of the rate cut as well. So hopefully it's just a little bit of maybe some investors just taking profit and such. Last few IPOs in Singapore are very bad. Central IPOs should not subscribe until market start to trade. I guess if you are more of a risk adverse investor, yeah, you could wait until post IPO to see how market prices the Centurion REIT. Yeah, with the Fed rate cut, which should we consider to accumulate? Yeah, so like Paul mentioned so earlier, we favor prime ESG because they are kind of one of the very beneficiaries from a Fed rate cut. Basically, their floating portion of the interest will see some direct interest saving from the lower Fed funds rate, as well as the fact that property valuations are likely to remain stable this year, and in our view, possibly a little bit of potential upside as well from the lower rates. And going forward in 2026, we foresee some cap rate compression also that will likely benefit valuations for prime US REIT next year. Yeah, but this year we think base case is flat with potential for a little bit of upside for valuations. Thanks.
Yeah, Fahmi, can you do? Yeah, okay, let me just try to answer some. Is it? Hello, is the connection bad?
We can hear you clearly, Paul.
there's a Adobe questions, but anyway, let's move on to, and also the Bowstate IPO. Okay, let me just answer this. Sembcorp, what is happening? Price up a bit, then down repeatedly. Yeah, I think it is still the concern is still regarding after the results. I think market is starting to worry about the whole demand and the margins, the spark spreads for the electricity sector in Singapore. So, but we are not that concerned. I think for us, we still like this stock. I think they are still going to, like we mentioned before, we're still going to raise dividends. So, and the renewables will still grow. So the second half will be a recovery in earnings because they have a huge capacity of renewables that will be coming on stream in the second half. Then the part two of the growth will be Senoko, which they've been raising stake. Of course, it's not the best quality earnings because it's an acquisition. Yeah, and the third is that we still think they're going to raise dividends aggressively after the share price performance. Their payout ratio is one of the lowest, about 40-50%, and they hinted very strongly that they will raise payout because they don't need such a huge amount of capex in future. Yeah, so we still like the stock, but I think in the near term, of course, there won't be any news flow. They're only going to release the results in February, so it's understandable that the market be weak. And the real gainer would be if they can announce that they're going to do some listing in Indonesia, in India of their renewables, which I think they said they're going to monetize. They didn't say how, but that would be one area that we think that they will probably IPO that. So we still like Sembcorp Industries, but I mean, obviously, without any particular news flow, then it will be hit. What could be the impact to the component stocks of the new age? Yeah, the next 50 index look like a mini REIT index, but nevertheless, I think the thing to watch for is I think it's still positive. It will at least highlight to investors the next 50 largest stocks on the Singapore market. Yeah, but the other thing to watch is also there's another eligible stock list also. So there's not only this 50, there's also like the STI. There are some of those smaller cap stocks that are eligible to be in this index. I thought that would be a more interesting area to also look at. Some of the names there are like Banyan, AEM, QNM, Alltech, Tuan Sing. But it's on the SGX announcement. There's, I think, like 20 names here, Valuetronics. So these are, I thought, would be a bit of the smaller cap ones to also watch. But what I'll be watching for now will be will there be any fund set up for this or ETF set up for this? Is Zixin one of the top 5 largest sweet potato in China? There is no official data, but we think it is one of the biggest. Otherwise, CITIC won't be working with them. So as you know, CITIC is one of the biggest I don't know, state-owned investment companies in China. So for CITIC to work with them on such a huge project in Hainan, I would think they should be at least the top 2 or top 3. Sweet potato, yeah. That's my own view because there is no real hard numbers. But I'll leave it to much. Yeah, I think for your presentation now, can I just say Prime US' current price is very much underpriced despite some run up. Yeah, we still think so. I think maybe Darren has answered that. It's still 0.7 times, 0.3 times price to book. So you can get a few. The upside will come from, of course, the narrowing of the price to book. They could raise dividends, and of course the whole operating metrics. So the risk reward we think is there because there are multiple upsides. If things pan out as we think directionally, the whole industry. Nvidia buying Intel into Intel, yeah, to us, the impact on AEM, yeah, we think is definitely going to be positive for AEM. We're not sure how much because the main thing is that Nvidia is ordering Intel GPUs. So what that will mean is that there'll be more revenue for Intel, and of course that will lead to more capex spending from Intel. That means Intel need to buy more machines, or they should be buying more machines, and that will benefit AEM. Yeah, but it's a real disparate way. I mean, you want to just go buy Intel directly, and rather than go through this indirect way if you really like it, I think. Please comment on AEM fundamentally. We were not really positive on AEM because the new customers haven't ramped, but I think with this piece of news, I think um uh, uh, any positive what I'm saying is that even if the numbers are weak coming out from AM because they know there's this turnaround in Intel, I think the market will give it an element of doubt. I mean, market will discount even if the second half results is big because we know the outlook will look positive because of this turnaround in Intel. So I think it, for me at least, thematically, it should be positive. I think for me on AEM. What price do you see Propnex by end 2025? It could be around these levels. I think the February results. Okay, the one thing that worries me is that if the next few property launch, if it's too, the problem is if it's too good, if it's too hot, we just worry the authorities might impose something. One possibility we tighten the leverage. Yeah. So Propnex is in this weird situation where if the news is too good, may not be positive for the stock. So that might actually cap the upside to the share price in the near term until the February results come out. Then maybe they may do some bonus shares again, and then announce some good dividends. So from here until the results, I'm just a bit worried because the news flow may not benefit them. If it's which is the irony. I mean, positive news is too positive, also you worry the authorities might act on it. Yeah. Okay, I'll leave it to the rest to answer. Yeah. Oh yeah. Okay. Let me answer this since no one's answered. Yeah. Which company that Paul alluded as a substitute play for Centurion IPO? It's a Weher. WEEHUR. So that's a substitute. Can you view on Weher again last week? Yeah. I mean, week to week price drops. Hard to call. But okay. So for Weher, for those who may not know, is in our model portfolio too. So Weher has largely three main business or four. One is of course they own the dorms. They own, if I'm not mistaken, don't hold me to the number. I think 15,000 rooms in Tuas. Then they have another 10,000 coming up in I think Pioneer Road. That's one part of the business. The second part is construction, which has been getting some new awards. And the third part is student dorms. And the fourth one that they are building is fund management. And there's a fifth one coming up, which if it does well, then this will take the stock to another level, which is doing property development in Australia, but a bit more unique. That means they are actually collecting the land. They are like collecting this type of land piece by piece and then develop. So we should yeah. So for us, we like her because number one, we think the dorm, actually the room rates for workers dorm is still rising. Like I mentioned, it's hitting $700. Of course, these can be short-term leases. The second thing is that and they got a new 10,000 capacity, so that will help their growth. Second is of course construction in general is doing well. The third is they still have a student dorm largely in Australia, and they have one that is maturing, which they could actually inject. So they could actually sell it and give some special dividend again. So there is the third driver to the share price. The fourth is a bit longer term. They're building a fund management business. The fifth is the land, the property development. That one, we need time to see crystallize whether it actually works or not. So this is something new. But this management always try to take a 5-10 year view. That's why they were some of the early ones to do student dorm in Australia. Yeah, so that's why we like it. Why it dropped, I'm really not sure actually. But if there's a lot of euphoria on the Centurion IPO, then it would actually help them. Yeah. Okay, I think I will hand it on to Zane first before I take on to the rest. Yeah, thanks.
Okay, thanks, Paul. I'll move to take some of the TA questions. Okay, the first one is on Yangtze Shipbuildings. Overall, I think it retested like 332, which was like the previous high. But overall, the uptrend is still very much intact. It's just trending along this uptrend support line. And currently, I think we might see some pullback or some sideways consolidation, as previously, whenever there's a high volume spike candles over here, we tend to see some form of sideways consolidation out there. So yeah, we might see a repeat of that. I think some support will probably be around somewhere around 3,322, which is the horizontal level, as well as the current 5 to 10 day averages. As long as it holds this uptrend support line, I think should be still it could still continue the uptrend now. So I think around 320 is a support level for now. Next is for SIA. I think SIA currently nothing much is going on. It's just moving sideways since the sell down end of July. Price is still holding a support at around 640. Retested it last Friday, but for now there's some resistance around 655, where price there was a bit of a price went a bit sideways at end of August, and then afterwards there was a bit of a breakdown in mid-September this year. So still some weakness above 655 to about 660. I think there's some resistance over there. So I think overall for now we might see some sideways trading with still lower highs being made. Next one is for the Hang Seng Tech ETF, HST. I think for this, actually, after a strong run last week, actually we see a retest of the 1,003 high. So I think for now, most likely I think there will be some resistance after such a strong run over here. Most probably some slight consolidation. So I think for now, some support is the $1 mark, the 5 MA level. If this can hold, we might see just continuous sideways consolidation. Maybe a retest of 103 again if it can hold $1. Yeah, if there's a breakdown below that, we most probably we see a further pullback towards like 98 cents. Yeah. So I think at these levels, most likely we see some pullback or sideways after a retest of the previous resistance. Next one is SMIC. Yeah, for SMIC, I think overall is still steadily trending upwards. So recently broke out of this $65 level, and currently still looking okay. So I think for now some support will be around 68.50 level. Then I think if you can hold along the 5 MA level, we might see price continue the uptrend if it breaks above 73. Yeah. So overall still very strong price action for now. Next one for Franco, we see a bit of a positive kind of price action on last Friday after it may try to break out this range of 140 to 146. Increased volume as well and above some of the short-term moving averages. I think currently on the weekly there's some resistance at the 150, 151 level, which is this 10 MA. So I think overall you might see some consolidation, but if you can hold the 5 MA around 145 on the weekly, and then try to hold this breakout of this range over here, 145, 146. If this can hold as support, I think that would be positive for price to do a rebound higher. So yeah, so for now maybe some sideways consolidation first to see whether a breakout of this is holds. Next one for Central, I think price showing some weakness for now after price over there were two high volume days over here above 180, but we see there's some selling quite strong selling above 180, a bit of a double top over here, and then we just over the past week there was price weakness where it broke down some of the short-term moving averages like over here 174, as well as the horizontal support over here around 167, 168. So I think for now, short-term weakness where price is below the 5 MA. So the next key support, I think, for bounce will be retest of this 156 swing low. On the weekly, there's also weakness where price was holding. Since like March to April, price was holding above the 5 and 10 day on the 10 MA on the weekly. But last week we saw a breakdown below that. So I think for now some weakness, where this will be like 167 to 170 probably be quite a strong resistance for now. So I think we might see some further weakness, maybe to test 156 and maybe some sideways consolidation take place afterwards. Okay, next one on the T for the 3 local banks. First one, DBS, also some weakness. A bit of a weakness for now, where there was a breakdown of this uptrend channel over here, as well as a breakdown of this $51 price level, where price had a breakout over here today. And yeah, so I think we might see some slight weakness for now, where price is below the short-term moving averages. So you might see some pullback, maybe to test close to the $49.70 to $50 horizontal support again. Next one for UOB, I think UOB also will be seeing some price weakness where there was a break below this $35 support level on the upward support line. Price is back to retest this 34.50 horizontal swing low support level. So we might see some bounce over here, but I think mostly some sideways consolidation between this 34.50 to about $35 area for now. Then for OCBC, yeah, all 3 banks also showing some price weakness for now. OCBC breakdown below 1670, so we might see some retest of this around close to 1635 area and maybe some sideways consolidation thereafter. Yeah, then I think for now maybe some resistance will probably be above 1660. Next one for Wilmar, I think probably nothing too much taking place for now. The price is still just looks like it's trading within the descending triangle over here with the key support still around 285. And price is facing resistance from this downward resistance line, which currently stands around 295. So I think currently doing some pullback over there, most probably sees, I think, just continue sideways trading between 285 to 295 for now. The next one for Mapletree Logistics Trust. Okay, so for MLT, I think price doing a bit of a sideways for now. I think the key level to hold now would be 124 here, where last week it reached almost at 129, 130, this horizontal resistance and some pullback over here. So we're testing the support over here, 124 for now. We might see a bit of a sideways consolidation if 124 can hold. Yeah, maybe 124 to 130 area. Next one is for the Mapletree Industrial Trust. Also retested around this horizontal resistance around 217 to 219 area last week, doing some pullback. So I think price might do some pullback. I think for now towards 10 will be the support area for now. Yeah. Yeah, then for CICT also some pullback for now. Retesting this support, which is around 229, 230. This our support line, and then also the breakout of this horizontal level over here. So I think this level should must hold for some support to just trade sideways between 229 to 235 for the time being. Yeah. And then next one is on FCT. Yeah, FCT, I think it's just trading mostly quite sideways. Yeah, price is just holding support. Back to test this support 232 and then resistance on 239 about there. So I think most probably some sideways trading for now. Yeah, then next support level will probably be around 228, which was the previous horizontal level. And then for Capital DC REIT, also just moving sideways, some pullbacks towards this previous resistance level around 234, 235 area. So I think we'll just trade sideways between 235 to about 240 for now. And in terms of the REITs, if you look at the IHSV index, currently doing a bit of a pullback. Yeah, following the rate cut decision last week. So actually it tested the previous horizontal support level around 1,110 level. So over here there probably be some resistance and I think a bit of a pullback for now in general for the REITs taking place, but support is likely to hold at this 1,075 to 1,090 area. The next question is on Duolingo, some US counters. For Duolingo, I think price is most likely doing some sideways consolidation right now first. Overall, it's been trending down, but price is currently holding some support at 270 for now, which is this quite a strong horizontal support previously since October last year. And yeah, a bit of a double bottom in the short term. So I think yeah, we might see on the weekly for now, I think resistance remains around 325 on the 10 MA level. So we might see some sideways consolidation taking place for Duolingo. And then for Essential, also something similar. Also price trending downwards, but in the short term, I think price holding a bit of a double bottom around 235, 236 this area. Previously, this level was a key horizontal support back in 2022, 2023 as well over here. So I think price will hold this support over here for now, most likely just some sideways trading. Then I think it needs to break out of this downwards resistance line over here. Try to break out of 247, then we might see some further bounce. Yeah, on the weekly, most probably 250, 255 area will be quite a strong resistance on the 5, 10 MA levels. Okay, next one, Adobe. So for Adobe, I think the price action is looking better. Price held the 335 level horizontal support and did some range consolidation over here. After the earnings, it was a bit of a pullback from the open near resistance, but it was a bit of pullback and subsequently very fast it turned back up to actually go back above this 360 resistance level. So I think it's quite positive. I think we might see some bounce in the short term to test around 375 this resistance level again. Then on the weekly itself, I think it's trying to break out this 5 and 10 MA resistance, which has been holding price down since I think June this year. Yeah, so we might see some short-term rebound, I think towards maybe 375, which is the 20 MA level as well. Okay, next was on Palantir. I think Palantir for now it's showing some short-term bullish momentum back again after holding this after the breakout of 162 over here, held the retest as support. And then Thursday also break out this 171 resistance. So it's back to test. Currently back to test 182. There might be some short-term resistance over here, given that it was a bit of a sideways trading at the top before price pulled back down. So we might see some slight pullback. I think price will hold the 5 MA as support for now, which is currently like close to 174. So I think price will trend along the 5 MA possibly to try and do a double top towards 190, I think, for now. Yeah, given the turnaround at 162, 163. Okay, next question on comfort level. I think nothing much is probably taking place right now. Yeah, I think it's most likely just trading sideways. 144 around there. It's 141 to 144 around there as support. Then resistance at 153 onwards. Then for Seatrium, yeah, for Seatrium also just moving sideways. Even though there was a break of this it held the support of 225 and break out of this 230 short-term downwards resistance line. There's still quite some resistance around 240. Yeah, so price just trading sideways between 230 to about 235 for now. Okay, next one, moving on to sets. Okay, I think for sets, right now, I think price is still just moving sideways. Still in this ascending triangle formation over here. Still higher low holding and support. So I think for now, I think maybe support around 325. And resistance still close to 336. About there. So I think we might still see some this consolidation take place, which has been taking place since the end of July. Okay, and next one for Intel, I think, yeah, let me see. Yeah, Intel after the big gap out on Thursday, I think currently doing some pullback. A bit of a pullback. I think overall we might find some I think on such momentum, price might find some support at the 5 MA level, which is currently at around 27. So we might see some bounce if it does reconnect at the 5 MA level. Then if it does retest the previous range resistance level around 27, we most probably could see some support around there. Yeah, if it does retest this previous resistance. So this was like a previous quite a strong, quite a big range between 19 to 27 that price has broken out of. Yeah. The next one on Keppel, I think Keppel is still consolidating in this this ascending triangle formation, still high lows along the way. The resistance still holding around close to 880 about there. So I think if we can continue to form these high lows, especially with this like possible bull flag over here, where price is just consolidating on low volume, where the volume spikes are bullish, then I think if you can hold the support over here around 860s, then I think there could be still a chance for a breakout afterwards of this 880 to trend higher. So I think for now it's just moving sideways still. And for Semco Industries, yeah, price has been just moving pretty much sideways, nothing much happening. $6 about 618. So I think still need to see price try to break above 6. This 618, try to get out of this range, then we might see some bounce take place. Yeah, on the weekly itself, I think reconnected with the 5 MA. It's just moving sideways for now. So really need to see try to our weekly close above this 5 MA itself, then we might see some rebound. Yeah. In some other questions, Yang Zijiang Financial. So I think Yang Zijiang Financial.
Sorry to interrupt them. Right? Take a minute to answer one question, Adobe.
Oh yeah, sure. Go ahead from.
Sorry then. Right. So there was one question on Adobe that Adobe has no negative as presented. The share price has dipped tremendously over the last few months. Can you share the primary drivers behind Adobe's share price dip? And really be helpful to know their main challenges and direction. So Adobe price dip due to the following reasons. First is that slower than AI monetization both by the market. So investors are concerned that Adobe AI initiatives like Fly, etc., are taking longer to generate meaningful revenue, which is true, because they are currently AI monetization is only make up about 1% of the total revenue. It's still rather small, and investors don't see the AI to move the needle anytime soon. And the second is on that they see that the outlook that was released is quite disappointing. The forward guidance has been conservative by the market, which is disappointing market because currently I think the people are expecting that with the addition of the AI to the business, supposedly I think they are expecting higher revenue, which is higher than 11% year-over-year growth. So that should coming from the AI monetization as mentioned. So especially since Adobe is such a big name, so we should see higher monetization at this rate right now. But regardless, we do think that Adobe's, and we don't have negatives particularly in our presentation because we are comparing this quarterly result. This is our expectation that we think we do price in the expectation, the development of the AI monetization in our report, where we don't see that, where we think that AI monetization is currently at the rate of what we expected. So that's why we don't see it as a negative in our report. It's just in terms of tracking. But regardless, we do think that Adobe's AI adoption is quite accelerating at the moment, with their direct AI subscription revenue already surpassed about $250 million. Although quite small, but the rate of their growth is really fast. They are growing double in the 2 quarters, the traction of the use of the product. So while the AI revenue still make up a small portion, still we see strong uptake and the international course is very strong. AI traction increased by 100% in 2 quarters, and this suggests upside potential, especially Adobe built on large user base and increased industry leadership. More importantly, we continue to see strong performance across Adobe core offerings because people actually looking at the AI monetization alone, that they forget that Adobe itself is the leader in the creative industry, and that itself is another value for Adobe. Thank you.
Okay, thanks, Fahmi. Yeah, I'll move back to TA on Yang Zijiang Financial. I think for now it's still a very strong uptrend. Price generally trading within this uptrend channel since the beginning of July. I think a bit it's getting a bit out above it right now. So very strong momentum, but I think for now there might be some slight pullback towards perhaps 116, which is like this horizontal swing low levels last week, as well as the 10 MA level. On the weekly itself, I think it tends to trend along the 5 MA on the weekly also. So that could be a support level to look at, right? As well, currently around 113 on the weekly 5 MA. Yeah, so that's for Yangzijiang Financial. Next question is on Pan United. For Pan United, I think price doing a bit of a sideways. I think price was on hold this around 121 level over here. So I try to break out 125, but not enough momentum to actually carry on with. So price did continue sideways, and you might see some further sideways over here since that price is unable to close above 120, 123 to 125 area for quite a number of days. So I think we might see some continued sideways consolidation where it might test the 10 MA on the weekly, now 115, for some support. So I think overall we might see some 115, 116 back again towards this lower end of this range. Next one on LHN. So I think very strong momentum for this one. Since the breakout of this ascending triangle over here, and just price, I think just doing some slight pullback over here for now. So I think we may see some supports around 90.5 cents. This swing low support, as well as the current 10 MA is around close to $1. So I think price might find some slight bounce over here. Yeah, then I think just trading sideways between $1 and $1.07, $1.08 for the time being. Okay. Yeah. Oh, okay. I see a question on the balance of risk. Yeah, just now. So yeah, so balance of risk so the Fed has two mandates, which is maximum employment and stable prices. So previously in previous FOMC meetings, you see that Powell has actually he's more concerned about the tariff-led inflation, but now with the labor market softening, he's actually shifted this balance of risk towards the labor market mandate. Yeah, so actually that's what it means by the balance of risk. He needs to juggle both sides of the mandate. Okay. Yeah, I think perhaps I'll leave some time for some of the remaining fundamental questions from my colleagues. Yeah, thanks.
Yeah, thanks, Zin. So hope you answered 45 questions. Let me just try to take on some. What's your outlook on gold and target price with a weakening US dollar driven by Fed rate? We don't have a target price for gold because it's almost impossible to do a valuation on gold. I mean, you can do all the relative valuations. There's no cash coming out from gold. Yeah, so it's hard to justify any valuation. But we can only use the environment, so the environment is still going to be positive. I think with the Fed rate cuts coming on, at least until up to next year when the new Fed chairman comes, I think that will the framework settlement on some of the conflicts that might probably take a bit of shine out of gold, but in general, the environment is still positive. CDI HE Trust, I don't recall. What's the outlook for NVIDIA after recent price correction with potential zero chip sales to China? All this will have a negative. Gigman covers NVIDIA. I think we still like it. The non-sales to China is really quite well telegraphed. You might get some bounce once the relations with the TikTok deal. I'm only doing all this guesswork, and with that, the next results should still give them like 50% earnings growth. But I think Nvidia is coming on to some speed bump. I mean, the growth rate is slowing down, but I think 50% still going to be really strong. But I think if you got to ask Yigma, I think he's on leave today. Yeah. Or your analysis on Samudra. Yeah, we don't cover Samudra, but we are not positive on the whole container sector. I mean, the container rates are probably down 30-40% this year. So we are not positive on the whole container sectors. I mean, that's our general view. They don't really meet investors. Likewise for ESL Marine, I don't have any specific views. Never met them. Yeah. But I think like we highlighted the last 2-3 weeks. I think we like the whole offshore marine sector. I think even though oil price is down, drilling activity continues, especially in the Middle East. And supply is hardly anything. On order right now is only, I think, 5% of the whole total fleet. Not like containers, you're talking about 30-40%. So that's why the whole offshore marine sector, we still very positive on it. Manuela, I think I leave this to Darren. But yeah, sorry for the audio. I think not sure why today is especially bad. I'll take the last one for hand over. UMS view on UMS. UMS, I think should be positive the next 2-3 weeks. I mean, sorry, next 2-3 quarters. Because I think they said that the LUM is ramping up. And also Applied, they mentioned that they could be taking on one more project from for you one more new project with Applied, so that should be positive for them. For LHN, is it better to accumulate LHN or upcoming REIT IPO? That one is a bit tricky for us. The difference with Centurion is that Centurion is going to give some free shares to existing shareholders, which I think LHN may not do. So from here to now, I think LHN can still run because their valuations or the market cap for the LHN or Kaliwu IPO could be better than what people expected. So that could be, but once they get listed, I'm not sure. Really do not know how investors going to view this. Because they might prefer to just take the pure play in Kaliwu, and the share price might react to like what Centurion happened. I mean, when the IPOs, the share price could take a knock. So there could be some weakness in LHN once it gets listed. I mean, that's my own view, of course. Yeah. I'll leave it to Darren. You got anything to add on the Baustit or CDL or Manulife and Capital? Then I think Darren, you can close it. Yeah. Thanks, Darren.
Yeah. So about state, generally and pretty but the answer in the chat, so I'll just run through CDL. Yeah, so about CDL Hospitality Trust, what's the FA and subscription? Yeah, about CDL Hospitality Trust, if you all recall, the first half performance was was quite bad, mainly because of the very weak Singapore performance. We have found like 14%. Just because as you all know, first half of 2024 was extremely strong with Korea so that was I would say the first half performance for that CDL Hospitality Trust was worse than expected, even though the data were already quite low. But going forward, we do expect CDL Hospitality Trust FI in Singapore at least stabilize, possibly around flat. But the positive thing for CDL is that their fixed rate loans are extremely low. So that is below 50%. So as a result of as you all know, the loan SORA is very fallen by over 200 basis points year on year. So they'll benefit from this lower interest expense almost immediately from the much lower human SORA. As a lot of their rates are on floating. Yeah, so that is outlook. Still also, but sometimes the unfortunately, I'll just answer one last coming from Manulife Capital CPO and also benefiting from going back to office at practice. Yeah, so generally in the US, a lot of the companies are already mandating return to office. So we are seeing fiscal occupancy of around 70% already, and we expect it to stabilize around there. So that is around 3.5 days work in office. So perhaps maybe some Friday or Monday couple of generally we expect it to stabilize around 70%. So it is similar for all PVs, but fundamentally, Capital Pacific and Prime Real Estate are doing much stronger as their assets are located in better geographies or better spread, and their occupancy is also much higher than the other Manila. If you recall, their full savings time, which is gearing still not below 50%, it's still 56, 57%. So likely they still need to sell some FS to here there. And Manila, their occupancy is 60+%, more Capital Pacific and Prime is already above 80%. So there's still a recovery there, and it is very likely that Capital Pacific and Prime both will increase. I mean, Capital Pacific is not paying dividends now, but Prime is paying 10% of the rating. So we are expecting that both of these will increase their payout ratio next year. Yeah, so those two are available over many economies. Manila is definitely still facing some challenges with the high inflation. First, and so with that, that brings us to the end of our webinar. Thanks so much as usual for joining us. Yeah, apologies for some audio issues today. Some audio might today. Try to improve. Yeah, moving forward. So thanks for that, and I hope to see you again next week. Thanks so much. Yeah, we also have some corporate insights webinars upcoming. We have Capital Week tomorrow, so please feel free to join us if you're. Yeah, thank you. Bye-bye.